There's 8 different types of LLCs that you could set up. Now you might be thinking to yourself, wait, what do I have or what should I have? Well, in today's video, I'm gonna break down the 8 different types of LLCs that we use as lawyers every day advising our clients. There's a lot of options here and it matters for your asset protection, your tax planning, and your wealth building. Let's dig into it. I'm Matt Sorensen. Let's build wealth. All right, now I'm going to whiteboard and outline all the different LLC types. Now I've got them here on the screen here so you can see the 8 different types. We're going to walk through them one by one. But the first thing I want you to understand is something we call the trifecta. We advise our clients every day in my law firm, KQS Lawyers, on this. And it's a way we separate operations from assets. Okay, so if you're a business owner or an investor, you've got to think this way as you're setting up your LLCs and doing your business and tax planning. Now, as we go through the 8 different LLC types, all the ones here on the left are operation LLCs. All the ones here on the right are asset LLCs. But those 3 things, what you set up, how you have it taxed, and how you operate it is what makes it one of these different LLCs and what matters for your tax planning and asset protection. All right, now let's start with the first one here, an LLC taxed as a sole proprietor. This is something you'd want to set up if you maybe have a side hustle or a new business where you're selling goods or services. Not talking about rental properties or partners or S corporations or you're a professional or any other thing like that. I'm just talking about plain vanilla business owner. It's just you. This could be a main hustle or a side hustle. Now, as a sole proprietor, what that means is this is going on to Schedule C of your tax return. You're paying self-employment tax on it and you're paying income tax on it. We like this type of LLC for someone making less than $50,000 a year, running their own business. You could have employees, but most likely you're not because you're making less than $50K a year. Now, the reason we like this LLC is asset protection. There is no tax benefits to this first LLC here. A sole proprietor LLC saves you no taxes. It's the same as if you just set up a lemonade stand and you called it Matt's Lemonade and you didn't even do an LLC, okay? The tax savings are the exact same. What this gives you though is asset protection. Let's say I have a customer, I'm a contractor and I get a lawsuit. Someone tries to sue me. Well, they can't sue me. I didn't provide the services. The LLC did. They're forced to sue the LLC. They can't come after me or my other assets. So there's asset protection planning to it. This is also a nice LLC to set up if you're just starting out and you're not sure how much money you're going to make. Maybe you'll do an S corporation or a different type of LLC we're going to talk about here in a second, but you're not sure yet. So you start with just LLC option 1 here, which is the LLC taxed as a sole proprietorship. You're doing it for asset protection. You're doing it because you're trying to build a legitimate business that can be bigger. Maybe you're going to elect to an S corp. We'll talk about that here in a second. Maybe you're going to add a partner. We'll talk about that here in a second, but this is option 1. Now let's go to number 2 here, the S corporation. Let's say you started this business. Let's say you're a plumber and you're like, all right, Matt, I'm making more than $50K a year now, or I'm going to make that right out of the gate. What should I be? Not option 1. You should be option 2, which is an LLC taxed as an S corp. Okay. It's an LLC you file with the state, but when you go to the IRS, you file something called a 2553 form to the IRS and you say, hey, I want to be taxed as an S corporation. I'm an LLC at the state, but tax me like I'm an S corporation. The reason you're going to do that, if you're making more than $50,000 a year net income after all your expenses, is you save on self-employment tax. Okay. For example, someone making 100 grand a year in an LLC tax as an S corp is going to have about $9,000 a year of tax savings on self-employment tax because S corps don't pay self-employment tax on profits. You got to pay it on salary. There's a lot of nuance to that, but I just want you to know for purposes now and going over all the 8 LLC types, you will save on taxes if you make more than $50K a year by doing an LLC tax as an S corp. All of our clients, doctors, dentists, realtors, engineers, consultants making more than $50K a year are LLCs taxed as an S corporation because you save on self-employment tax. I have an S corporation. Okay. Now I've got some other videos on this that break down how that tax savings works. Make sure you check out those videos here. I've got a link below too. Even Joe Biden did this and Jill Biden had this strategy. Okay. This is very vanilla, common tax strategy and planning, not anything aggressive. Okay. I don't want you talking about anything crazy here. So option 2, LLC taxes and S corp. Those of you operational businesses selling goods or services making more than $50K a year. All right, let's talk about option number 3. And again, we're still staying on the operations side here. And we're talking about selling goods or services. I'm not talking about real estate or investments or assets. We're going to come to those LLC types here in a second. I'm just talking about operating businesses, making money, selling goods or services. Let's say you're in a partnership structure, okay, and you're selling goods or services. You would have an LLC that receives the income, right? It's going to pay all the expenses, and then the profits are going to drop down to you or over to your partner. Let's say you're 50-50 LLC and you have some other partner in your business. Well, we're going to do an LLC taxed as a partnership. Now, the tax form you file is called a 1065 partnership return. In that return, the company says, here's what we made, here's all of our expenses, here's the money that went to Matt, and here's the money that went to his partner. Okay, and you get what's called a K1. It's kind of like your 1099 or your W2 for your share of the income or loss from the partnership. Now, partnership LLCs are great because it's a great operating model when you have multiple partners. This could be one partner, 5 partners, doesn't matter. But what happens here is the business has asset protection. We still have limited liability from the LLC, just like in 1 and 2 before. Something happens in the partnership, they're forced to sue the LLC. From a tax side, it's splitting up the taxable income for you on your percent based on your ownership percentage, and your partner or partners based on their percentage ownership. They're going to get the tax liability for whatever share that they have. Now, you might add in S corporations here. For example, you might have your scenario where you have an S corporation or an LLC taxed as an S corp, and that owns your 50%, and then you own that LLC taxes an S corp 100%. This is the structure I use. And my law firm partner, Mark, this is what we have, okay? Our law firm partnership and Main Street Business Services, some other companies, is an LLC, or it's a partnership entity like this, but I don't personally own it. My S corporation owns it. The profits go from the partnership LLC down to my S corporation. I do my tax planning down here. I save on self-employment tax here, okay? Remember, this is entity number 2 being used in connection with LLC option number 3 here. All right. Again, there's some complexity to this, but we still have the partnership up here to operate as a whole. You can have an LLC taxed as an S corp with multiple partners, but it is clunky. The tax planning has to be the same for everyone. The salary dividend split and profit split you do in an LLC taxed as an S corp becomes super messy. We never recommend that. If you're doing a partnership, just have a partnership LLC. Each individual owner can decide how they want to hold their ownership. Do I personally want to be an owner? Do I want to have my S corporation as an owner if I have one? Each individual owner gets to decide there and do their own tax planning. That is easily the best way to do it. So that's option number 3, the partnership LLC for selling goods or services. Again, operational business. A couple options of what happens underneath and how you're going to own that. Maybe your S corporation owns it, maybe you individually own it, but the S corporation would be added in, of course, from a tax planning standpoint, where you're going to do some saving on self-employment tax. All right, now LLC number 4 is the PLLC. This is called a professional limited liability company. Maybe you're a doctor, a dentist, a lawyer, an architect, some type of professional. You technically need to have a professional limited liability company. This is dependent on the state you're in, but most states require certain licensed professionals to have a professional limited liability company. Now, what happens here is I can still add in the S corp election. So this operates like entity option number 2, an LLC taxes an S corp, but because I am a professional, it's actually a PLLC when filed with the state. Now, some states you might do a professional corporation, and that can also have an S election to it, or you can do the professional LLC. That seems to be getting more popular over time over the PC and professional corporation. Now, if you're a general contractor, electrician, there's some licensed professions, even though you have a license with the state, you're not forced to do a PLLC. It's a lot more of the white collar professions, I have to say, that get sucked into this where they have to do the professional LLC. So LLC number 4 here, again, typically going to be taxed as an S corp, but you could also be a sole prop. Maybe you are a professional, but you're just getting started out. You don't know if you make more than 50K net a year. Maybe you do this on the side. Maybe you're a physician who picks up some work on the side, but otherwise you're paid W2 from a hospital. So sometimes you may still be a sole proprietor. But again, if you're making more than 50K a year, we want this PLLC to be taxed as an S corporation. Now, let me just show you what I mean by having your LLC taxed as an S corporation, how that saves you. Okay, let's say you were entity number 1, LLC taxed as a sole proprietor. Okay, and let's say you made 150K gross, 50K in expenses. So you had 100K net that you got to pay yourself. All right. Now, you pay income tax on this, of course, or whatever tax bracket you fall into. But before you even pay that, you have to pay self-employment tax. This is Medicare and Social Security. It's 15.3%. So you're going to pay $15,300 here in self-employment tax if you made 100K. Now, however, if we had an LLC taxed as an S corp, or this could be a PLLC taxed as an S corporation, same example, 150K gross, 50K expenses, 100K net to pay myself. What happens now is I get to decide on how that income goes to me. This 100K net, you can do something called a salary dividend split, and you need to pay yourself a reasonable salary, but that could be, let's say, $40,000 in this example that you're going to take as salary. And then it would be $60,000, let's say, that you're going to take as dividend income. Now, why am I going to do that? The primary reason you're going to do this is the IRS and the tax code is very clear. There's no self-employment tax on dividend or profit from an S corporation. None. I only got to pay self-employment tax over here on the W-2 wage that I took because I did work in the business, and I got to take a W-2 when I do the S corporation. But now what's happened is I'm only paying 15.3% on $40,000. That's like $6,000 that I'm paying. In other words, my savings here is $9,000. I only had to pay the $6K over here, but I got to save over here. No self-employment tax was due on the $60,000. That's a 15.3% savings. All right. So that's why I do an S corporation. We've recommended them for tens of thousands of clients in our law firm, KQS Lawyers, and why it's such a popular entity structure for any small business owner making more than $50K a year. Now, if you're like, well, Matt, I'm making $25K a year. Why don't I do this? Well, you got to do an S corporation tax return. You got to do quarterly payroll. You're going to have a couple $1,000s in expenses to do this structure versus just an LLC tax as a sole prop. I don't know that the tax savings make up for it. That's why we kind of say 50K net is when to start looking at this. Under that, just stick with an LLC taxed as a sole proprietorship. Even though you might be able to eke out some tax savings there on self-employment tax, the costs for the accounting work and the payroll returns don't outweigh it. In the end of the day, you're going to be behind. Okay. So quick little tip there. That is the savings on the S corporation. Again, I got other videos and content that go into much more depth on that and show you how it works at higher income levels as well, because there are some phase outs on the self-employment tax. But again, you'll still use it even at higher income levels. That's the operational side. Those are the 4 LLCs you're going to use from an operational standpoint. Sole prop LLC, S corporation LLC, making 50K or more, partnership LLC, if you got a partner in your operational business, and the professional LLC or PLLC for those of you that have a certain licensed profession where that entity type is required by your state. But remember, you then get the tax option is this an S corp for tax purposes or a sole prop. All right, now let's move over to the asset side of the equation and talk about the LLCs that you might use for your assets. Now, the first and most common is simply an LLC for your rental property. Okay, I have an LLC for the rental. I don't want to own the rental. If the tenant slips and falls, they could sue me personally. I don't want that. I don't want to put all my personal assets at risk. So I use the LLC for asset protection here. Now, if the tenant slips and falls, they have to sue the LLC. They can't come after me personally. All right. Also, I want to hold this separate from my operational LLCs. I don't want to hold rental properties in my operational LLCs. What would happen is if something happened in the operations of the business, they could sue the LLC and get the equity in that rental property. So I want to hold my assets separate from my operations. All right. But what we're doing here with the rental property is this is not a tax strategy. This is an asset protection strategy over here. Income from a rental property is either rental income as you own it or capital gain income when you sell it. Those incomes you do not pay self-employment tax on. They're automatically exempt from self-employment tax. So there's no reason to run it through an S corporation or to do an LLC tax as an S corporation. Now what's happening here is the income is simply going to go to Schedule E on your personal return. It's going to flow through down on your personal return. Let's say you had the PLLC or the LLC taxes and S corp. That's going to go on an 1120S federal tax return. You're going to get a W-2, and then the K-1 has your profit, no self-employment tax on that, and that's going to come down to you personally. Now I have a trust down here just for a second. You want your trust for estate planning purposes. It's not really an asset protection tool. We want it for estate planning purposes. Your family can avoid probate. You can put provisions in there to protect your family from creditors or other things once you pass on. But we want this all coordinated with your estate plan as well. Okay. All right. Let's talk about LLC number 6, the partnership LLC for investments, rental properties. This could be the rental. This could be the business you're passively invested in, not working in here. Let's just stick with the rental. Okay. Now in this entity, okay, I've got the LLC and I own it 50%, but I've also got a partner in here that owns the other 50%. Now, what you're going to have is a tax election on this LLC to be as a partnership. You have to do that with the IRS when you get the EIN, and you're going to file a 1065 return, similar to the ops side when we talked about the partnership for ops on the LLC. The difference, however, is we're not adding in an S corporation below. There's no reason for an S corporation. Okay. Again, asset type income, rental property investments are not subject to self-employment tax. So there's no reason to add in an S corporation. S corporations also have passive loss limitations, and I might want to take some passive losses on these real estate and or other investment assets in here. So just bottom line, don't mix S corporations with assets. Use Use them for ops, but never mix them over here on the asset side. So we file the 1065. I get a K1 that has my share of the profit or loss. My partner gets a K1 for their share of the profit or loss. This gets picked up on Schedule E on your personal return, and the partner does the same thing with their share, whatever their percentage might be. So that's the partnership LLC for investments or assets, entity type number 6. All right, now let's go to entity type number 7. This one could be my favorite. It is the IRA LLC. Now here, and I'm just going to do a rental property again, we'll keep it simple. You can have an IRA that owns real estate. You can have an IRA that invests in a small business or a private company. If you haven't followed me for a while, you might not have heard about this, but it's called the self-directed IRA. I wrote the #1 book on it, and I have a company that has $2.5 billion in assets and 20,000 accounts doing this. People using their IRAs to invest in private companies, to invest in LLCs, to invest in rental properties, to do private money lending, to buy crypto, all these quote unquote alternative assets that you can't get on Wall Street. Now, what this IRA LLC entity type is here is my IRA is going to own an LLC 100%. Our law firm sets these up. We've done them across the country for 20 years now. That LLC will have a bank account. That bank account is where the IRA is going to invest its cash. Now, you don't own this LLC. Your IRA does, but you own the IRA. Now, of the LLC, you can be manager of the LLC. Again, you don't own it. The IRA owns it 100%, but you're manager of the LLC. Now, this LLC can go out and make investments. You have checkbook control of the LLC, and you can send the wire, write the check, use the debit card to pay for rehab or anything else. So I can go buy the rental property down on 123 Green Street. Okay, I've done this myself. Check out my other video where I showed you how I bought a rental property with my own retirement account, and I go into the details and explain the IRA LLC more in depth. I've got other videos and content that on as well that we'll link in the description below, but I couldn't go through these 8 entity types without mentioning the IRA LLCs. Now, this LLC, even of itself, has multiple options in how you can structure it, but the point I want to make here is if you want to self-direct your IRA, invest in real estate or other private assets off Wall Street, a very common structure is this IRA LLC. It takes a self-directed IRA, but we do at my company, directed IRA every day. Click the link. You can talk to our team. I've got a lot of content on this, an entire podcast dedicated to this. So that is entity type number 7, the IRA-Owned LLC. All right, now the last one here, and I got to go down to another page to explain this, is the Series LLC. There are about 20 states that have something called a Series LLC that you're going to want to use for assets. The most common client we use this for is a real estate investor that has a lot of rental properties. Now, let's say you had 5 rental properties and you were just doing entity number 5, you were doing the real estate LLC. And let's say that this LLC owned 5 properties. Remember, we're doing this structure for asset protection. But here's the problem with this. Let's say that a tenant slips and falls on property number 1. Well, they can sue the LLC. They can't come down to me personally. They can't come over here to my other LLCs, my operational LLCs, or any other LLCs I hold that own assets, but they can get at this LLC. And if it owns 5 properties, all of the equity in each of those properties is at risk because of what happened on property number 1. So some people like to say, well, I don't want to put all my eggs in one basket then. I don't want the liability. Maybe I'll do a separate LLC for every property. That's one option, but it's very expensive. You're going to have multiple LLCs, multiple setups, and it's one option that we do have clients do. If you have a lot of equity or you've got commercial properties, you're definitely going to do that. But if you've got single family properties with $100,000 of equity per property, I'm not certain it makes sense to do an LLC per property. But what does make sense is the Series LLC. Now, what the Series LLC allows you to do is to adopt sub-series. So I file one master LLC with the state, and then that master LLC can adopt subs without having to do a state filing. Now, there's 20 states that do this: Texas, Illinois, Nevada, Utah, Tennessee. Okay, those are just some of the common ones that we're setting up. But what happens here is the master LLC adopts a sub-series LLC, and that sub-series LLC owns the specific property. And this could be sub-series 1, 2, 3, 4, call it whatever you want, 5, and they each own their own separate property. Now, in the Series LLC structure, if something happens on property number 1, they can only sue sub-series 1. They can't get down to the master, and they can't get to the other sub-series. So it's an asset protection strategy, again, most popular for people who have multiple rental properties that have more than 50 to 100,000 of equity. What I would say is if you have a couple rental properties in an LLC, but they have less than 200,000 of equity, I don't know that I would do this. But if you have a couple rental properties and more than 250,000 of equity, let's look at doing separate LLCs, or a Series LLC if you're in one of those 20 states that allows for a Series LLC. Now, I hope this was helpful in understanding the 8 different LLC types that you could set up to protect your assets, save on taxes, and build wealth. Now, please, if you're like, man, you blew my brain, man, I'm super confused, I don't know what to do, or I've got a lot of work here to do, I didn't know these different LLC types, get a consult with my law firm, KKOS Lawyers. Talk to one of our lawyers. We'll do a trifecta for your specific situation, where you're sitting now and or where you're trying to go. We'll outline the LLCs and the tax planning, asset protection strategies that'll save and protect you. And please make sure you're subscribed to my channel. I've got a lot more content on wealth building and tools and strategies to keep more money in your pocket. I'm Matt Sorensen. We'll see you next time.